Hello, everyone. Welcome to today's session. Let's go ahead and jump into this. Market's continuing to have a pretty nice rally here going into this. Hey, Rosie, we shut that door, please. Sorry. Making a few location changes here. Let me jump over to direction alerts. Market conditions towards the upper end of this range right here. Bull market 24.84, continuing to top out right here. We're now getting a little bit of a support at this range we're going to look at right here, and on S&P 500 we're continuing to see momentum kind of stuck right here. We've got a little bit of an update, and it's breaking through a range that we're going to talk about here as well. And also breadth really hasn't moved a whole lot. We've kind of seen breadth stuck right here now. Buy-sell ratio, it's still that negative. We're still red above green, which means we have this buy-sell ratio sitting at 0.33, less than 1. So essentially all that means is that we've got the bulk of the database in downtrends, okay? And that makes sense based on what the markets have been doing right here as well. S&P 500, though, having a pretty sharp move back off of this low. We went up back to this 618 level. We've now cleared the 50%, and then making a test right here. What do we want to watch today is how we end up closing around this area. If we can continue into some strength and then kind of close back up that to that 537 range, then we start to add that support level. We start to add some support. If we can't hold this level and we start to move back down, we're going to be stuck more than likely if we do fade and retrace that 537 range to 529 range. Okay, so let's watch to see where we end up closing right here. What this starts to do from this level is once we're back into this hold range, now we can start to, it doesn't do a whole lot for us yet in terms of allocation. We're just getting stopped out of less trades. So we're continuing to add in, but we're able to add and then build that portfolio back up again. And as the market conditions start to improve, we can add larger position sizes if we want to, okay, or we can just continue to hold on to a certain allocation that we've got right now, around 20% or less in equities based on these market conditions. We know that we're in an uptrend still. We know that we're in a bull market because we're focused on, we look at direction alerts and go out here and just look at this long-term signal, okay? Sometimes it's helpful just to go back to that picture and say, where are we right now? Where are we at in the last 20 years? Well, we're sitting right here. We've come off of the top right here. We've had a really nice run up from the bottom. We've had everything that's been happening, really after COVID. This was the COVID retracement. This was COVID back here. So just looking to see where we've been and where we're at, and knowing that we're retracing a little bit, but we're still in a really strong uptrend. And that is now at some levels where it can start to be retested. This 519 range, start to retest it or test it and see if we're going to continue this rally higher. We certainly could, okay? But we're not going to be a little bit more aggressive into that trend until we see S&P 500 start to go yellow. It's going to go yellow for a little while, unless it keeps going straight up. It certainly could, but without some kind of a pullback, I'd be surprised. The most bullish scenario would be that we retrace back down to these ranges, maybe even retest all the way down to these lows, find some support, and then if we're going to head higher from there. That's probably the most bearish scenario. The more bullish scenario would be that we continue to hold these ranges, and then we get some support. Maybe we rally up and test this, come back, have a little retest here. And then we get that bottoming process here that could break us back and get back into momentum somewhere back over in this range. And as this process is unfolding, we're adding a little bit more and more to the portfolio size. Okay, we end up getting portfolios. We get a little bit more larger positions coming into that. Okay, we can increase that. I've kept these position sizes relatively low right now, around 1.5%, and just because of the volatility right here. But we want to continue to add in. We've got a gold stock in there now today that's working up 3.86%. That was in the new buy scan right here. So you've got new buys, you've got this gold stock right here, and that was increasing nicely yesterday. Good solid confirmation bar, increased volume. Okay, and we simply go into that trade, or simply go in the morning before this bar has happened. Okay, before this bar has happened, it looks something like this, and we determine what is our risk. I'm going to say, okay, it's $2 stock, so what does 500 shares look like? 500 shares is 1.6%. We can probably go a little higher than that. 1.62%, 750 puts us at 1.75. Okay, and if we put a stop loss, right down below these levels, or we could even say, if you wanted to do a 10% stop, or just a certain percentage stop, you could do that. Or typically we'll go down below one of these ranges, down below the most recent hold signal is ideal if it's not too far away from the current price to set too wide of a stop. So if we say $2 stop, we've got 0.3 at risk. Okay, if that's a little too high for us, we can either increase the stop higher. Okay, instead of having a stop loss at $2, we go up to $2.15 or something like that. The risk of having too tight of a stop is that it comes back down, tags that stop at a natural support area and then takes off again, versus a little wider stop that allows it to maybe retrace and get down into these resistance areas and then find the support that it ultimately needs to continue. Sometimes that first signal is not the one. You can see even here, you get a retrace, probably a stop out. There's another chance for that. Remember what we're looking for. We're ultimately looking for momentum. Okay, we're looking for this scenario. Let me see. I want to go back to NVIDIA, because this NVIDIA is a good example of this on the 2-year time frame. We're trying to wait for this pattern to start to happen, and there are times where it happens and then it retraces and we get this whipsaw. Okay, so as we're looking for new opportunities to go to the upside, then we have to realize that even when we take those greens and in the expectation of this, sometimes it's flat, sometimes it gets stopped out, but typically those stop losses are relatively small, 7 to 10%, typically, sometimes a little bit bigger than that. But in most cases, that's what we're looking for. So if I go back to NGD, okay, then there could be scenarios where something like this, okay, but we've seen that this is attempting this now twice, potentially a third time, getting ready for a breakout area. It's got real solid support happening right here, and that is that's enough. That's enough to be able to take on a trade and say, yep, let's go ahead and add that in, particularly with the volume. So that's kind of that process that we're walking through and looking through is what's working right now. What stocks have those uptrends in place, and typically those are going to be this new buy range or anything with a higher rank. Now we don't have to. The risk is that the market conditions are still bearish, right? So we go back to the buy sell ratio and say, wow, we're in this downtrend. We're kind of trying to fight to the upside. Maybe I don't want to take a trade right now because of the volatility and wait. Maybe I just want to wait for the S&P 500 to get back to this, and then I will start looking for stocks to buy into again at that point. Okay, that's certainly a strategy. That's probably the most conservative strategy, is to just be like, okay, I'm going to wait for this to happen because I don't want to deal with all this, and I don't want to try and pick stocks in this mess and see what happens. The only downside to that is potentially there are opportunities that can still grow the portfolio even though we have a smaller allocation. So we can still be buying stocks even in a bearish or a downtrend, but typically we've reduced the portfolio size and we're just trading smaller portfolios, less stocks, and less position size as well. That's referred to as the wheel methodology, where you're adding into something each day. If you're not, that's fine. It's just, it's still kind of going to be the same money management techniques of how you're entering and where you're placing your stop losses and how you're exiting those trades. But market conditions are determining the portfolio size. So we've got a smaller portfolio size right now because we're all the way at the top of this trend. As these trends enter into new trends, we're really in the bulk and having 60, 70, 80% equity portfolio exposure versus cash when we're in the kind of the meat of those trends sitting right here. So now we're towards the upper end of the trend. We don't want to have as big of a portfolio because the probabilities of all of these going higher is a little bit less. That being said, you could still continue to do that and have a larger portfolio size as well, because there may be enough stocks rotating through during these cycles. And that's kind of, it's kind of a micro, uh, um, um, what's the word I'm looking for? Allocation or structure in terms of setting up this portfolio. The term will come back to me here in just a minute. But let's take a look at some of these other things in terms of the bias. So we focus on this top-down approach where we say, what is the market doing? We just mentioned that we're at the upper end of the trend, but we're retracing back slightly. We're still in a bull market. And that's why when we say, and I have these updates here, and it's mildly bearish in a bull market, because we're in this bull market, but the bearishness part of that mildly bearishness part of it is coming from this kind of a pattern. Okay, we're still stuck down in this low range. The buy sell ratio is less than 1. Okay, so there's just weakness in the market, and that can actually be good still for stock pickers like we are, because we only need 2 or 3 or 4 or 5 or 6 stocks during whatever trend is happening to still be profitable on some of those trades. The real big issue though is when markets are retracing like this or in corrective moves, especially when they move down. Like right now we're moving up, so everything is moving up. But if we were going down, sometimes even those gold stocks will move down. So even buying into the market in a corrective move can sometimes be a little bit more aggressive, a little bit more risky. We're taking on more risk because the market as a whole is that giant river. What direction is the current moving, and why do we want to try and swim against that? Let's jump over to sectors. We talked about this. This is along those same lines, and that is that's commodities. Sectors here where we've got, right now we've only got 2 stocks in uptrends, and we've got the rest in hold and the rest in sell. Okay, so essentially these are downtrends, these are uptrends, and these are transitioning one direction or the other. They're transitioning from a sell toward that buy direction, or they're transitioning from the hold towards that sell direction in that overall downtrend. Okay, and then commodities, we know that gold has been working the last couple of days. We also saw a big move yesterday in oil, retracing a little bit here today, but we've got commodities which are lighting up a little bit. We've also got bonds which they've been holding relatively steady, had a decent retracement, this counter trend move. TLT, which is the longer term bonds, moving back up now today, back up in that momentum zone. This is that creates that trend profile that we're looking for, and ideally holding that 236 on a 6-month time frame. Okay, that 236 is going to change when we move out on our time frame, and those time frames are just saying what's the trend direction. So when we go out to 2 years, we're still looking at 1-day bars. Each of those colored bars are still 1 day, but we've just got a little bit bigger perspective of what's happened within that window of time. Okay, in this window of time, it's obvious that we know that bonds have been moving down. Now they've been moving higher in anticipation of the Fed getting inflation figured out. Then we got this big rally, this retracement back here where they're like, what the heck is happening? Now it's the Fed has to start to move interest rates because we're running the risk of inflation. So this is the bond market. As bonds are moving higher, interest rates are moving lower. Okay, so, and you can see this is, that's ultimately where we want those interest rates to be at, is moving lower right here, so we can get the economy and get things back on track. That's the long-term bond. The short-term bond, SHY, also looking really nice, even better in terms of a trend profile where you're getting pulled back into that 236, holding the momentum zone on the 6-month time frame. That's the most high I don't know if that's correct grammar, the most high probability trade setup right there in terms of it's showing its demand. It's kind of showing us that there is demand there, and when we know that when the demand is here, that's a higher probability that this is just profit taking. This is not selling. Okay, you're getting a natural run up, and it's just profit taking, and the buyers are standing by. They're ready to move back in. When you get a deeper retracement back into these other zones, that is selling. You're getting profit taking plus you're getting selling. that creates a little bit more supply, that creates more distribution. Things are falling off, which is lessening the demand on the other side. So when we're looking at these zones, that's why we ideally want to see something that's holding that upper momentum zone, because the chances of it just being a correction and moving higher are much higher. Now here's a good example of a deeper retracement, and now you're getting back into, okay, now we can start to get interested again. Okay, even as the market is starting to strengthen again and we're looking for stocks, what the thing not to do is look at this data and say, oh my gosh, why didn't I buy here? Or why didn't I buy on this pullback? Okay, all of that is now irrelevant data to us, but what we do know is that the price has been there and that there has been demand moving to the upside. And we know that eventually we're going to catch, this is the potential outcome, and that is we want to see this corrective move moving through those trends and then coming back into this kind of a setup right here in anticipation for that move higher. Does that always happen? No. Okay, but if market conditions continue to strengthen, we may start to see that. These guys also have some pretty nice looking fundamentals right here recently. Quarter EPS 500%, sales 46%. Remember that what drives a stock is the underlying company. A good company, a good stock has to have a good company backing it or underneath it. That's the root of why the stock is moving higher, is because the underlying company is becoming more valuable, typically through additional sales or more importantly, profitability. The earnings per share is continually increasing, and that is what ultimately the stock market is looking for, is a company that's growing. And this would be the time now to say, okay, or if you're looking for a scan, say here's a setup that I'm looking for on a stock that's got high rank in the momentum zone, a new buy signal, maybe some increasing volume would add additional confirmation to that, as well as you're going through the scans and you're looking at these and saying, my gosh, there's so many. Well, that's fine. We know that they're all probably good candidates for the most part, because they're all in this upper rank. They're already moving higher, even like Costco. Costco right here is another good example to say, well, Costco, the stock of Costco now clearing back up, going through this counter trend. These kind of patterns start to also add to the bullish case for the market as a whole. When we start to see more and more of these kind of stocks that have moved aggressively back into momentum, the only risk is that we sometimes get these at this phase, those whipsaws, or it comes up, says hello, buy me, never mind, come back down, you get stopped out of those trades. But as we know from the money management, a stop out is not a big deal. Okay, it's worth the risk when we know what the risk is, and we're entering into something that we know can be potentially systematic for us, meaning we know what to do right here. Okay, market conditions are moving higher now. The $850 stock price may be a deterrent as well on some stocks, but if we go through these new buys, and let me go over here and here, look through some of these new buys, we may see a couple of others. NGD, the one we talked about. There's CAVA, the one we just talked about. BIST, which is an energy stock, another interesting one there, because we've seen oil have a really nice move back up into that. It's still correcting, but it's moving higher as well. That 1 year time frame may show that we're just about ready for a breakout. We can break out of this base area right here. This is a great place to start to set up for the possibility of more momentum moving higher. Let's go out to 2 year. So even 2 year there, that's a pretty decent counter trend. You even had a whipsaw here, which adds potentially to the fact that this won't be a whipsaw. It still can happen, but when you have one already, you're usually not going to get two in a row and head back down again. So in this stock here, that's a very interesting setup. Now let's go through this as an example. Let's say I saw this stock in the scan, I pulled it in, I decided, hey, what's my risk? Okay, I already know what my outcome needs to be, or I want it to be, and that is I think it's going to move higher. It's going to continue to have momentum higher, and then from there, now it's okay. How many shares? What's the risk I'm going to be taking on? It's a $48 stock. Oops, if I had 10 shares, it's a little bit small. I can go up to about 40 shares. So 40 shares is 1.88% of my portfolio. That's a position size of about $2,000. Okay, here on a $100,000 account, and that is 100% risk trade at risk. Why? Because we haven't entered our stop loss in yet. Okay, so now we want to know, this is the worst case scenario. This is if this stock drops to zero, I'm out $1,900. Again, the probability of it dropping to zero, at least anytime soon, that's really low. Okay, but we do want to make sure that this is our first capital. This is our initial capital moving in, meaning that we have no profit from this. This is our wages. This is our savings. This is our money. I mean, it could be profits from the cash pool, obviously, that we've been rotating into, but this is the first initial trade, and so we have to consider that fresh new capital. Now let's just go with the stop loss right below this 236, okay, and say 45.50. That's going to be a pretty tight stop loss. So if we go 45.50 right here, that puts us at 1.1 or 0.13. So this, with a tight stop like that and an allocation at 1.8%, this is a really low risk trade in terms of the amount at risk, the portfolio at risk, because we can typically, within the trading plan, go up to 0.30. Okay, so if you go up to 0.30, obviously you're going to be closer to $300 on this. Now, these are all based on 100,000. If you're using a $10,000 account, these numbers are a lot more reasonable. That's $13 at risk today. So if you decided to buy into that trade, it's going to be $195 to pick up probably 4 shares, and you'll have $13 at risk. Okay, those are numbers that are certainly still manageable. It's still real money, right? And we can still grow that, and we will just do the exact same process, and we'll just work towards gaining this, adding more into it, becoming additionally profitable on that money. It's a great place to start. You got to start anywhere, right? Today's the best day to 20 years was the best time to start investing, but the second best time is right now. Those are I think it's the same saying with trees too. Anyway, that's this process. Every single time we're going through, we're looking for our signal, whatever our criteria. Now we can add a little bit different, say, this is a really nice looking bar. That's a good, solid A grade type bar. It's about the best you could be, where it opens at the low, pushes all the way higher all day long, and then closes at the high. There was never a situation like this where it rallied all the way up and then sold all the way off during the day. Or here it opens higher and it moves lower. Or even an entry bar like this. Okay, this would be a good solid entry bar. This would still be okay, but not as solid of confirmation. We want to see these confirmation bars typically look like that. Confirmation meaning there's interest again, there's demand again, or there's continuation of demand that has started at some point here. But we're most interested in what's happening from here on. We're not as interested in what has happened. Okay, we're happy that it happened. We're glad that it's there, but now we're interested in what's going to happen next. If it doesn't happen, where are we going to manage our risk so that if it doesn't move higher and it stops us out, that we know exactly what those numbers are. Okay, and that's all within a trading plan to be able to follow that exact system. How big of a position size is okay? What's my portfolio at risk after I've included a stop loss? Okay, all of those are rules to set up so that you know that you can manage this without having emotion involved. Why am I doing this? Well, it's because my trading plan, I've got X, Y, and Z. Okay, and remember, you can get access to your trading plan or a basic template of the trading plan right here, 4 steps right here on this under training, 4 steps and the trading plan template. Just click on that, and this is going to give you a template that you can go through and say, what setups will I trade? Market conditions, I need to have a buy sell ratio of 1. I'm looking for new buys. Everything needs to be up. I've got to have a rank of 98 or higher. Okay, those are the volume must be greater than 20%. Those can all be criteria that you either add into or subtract from. And then you're also getting, here are, I've got to have a bullish market direction, or again, buy sell ratio greater than 1. How do I place my stops? What percentage am I using? Do I do bar by bar? Do I do the low of the most recent hold bar, which I just mentioned? Do I do below the Fibonacci 236 on a 6-month chart, which we also look at a lot? I'm going to know in advance what my stop loss location is so that I can set it up and I'm not surprised by it. If I get stopped out, I know that that's just a function of the process, and I will be okay with that, whatever that number is. Okay, let me just double check one thing here. I think we're good to go. I'm going to end on that note. Appreciate everyone's time and effort today, and we will see you next time. Oh, wait. Yep, good to go. Thanks a lot. Bye now.